All right, everybody, I've got a fascinating topic for you today. This is called fixed income analysis, and we are going to use Python, of course, like I do for all of my videos, and we're going to focus on fixed income instruments, which are basically bonds. You can have a specific bond or a couple of different bonds or a bond fund, which is basically an ETF that consists of bonds as the underlying instruments. An ETF is an exchange traded fund. You have a couple of benefits with an ETF. You have a professional money manager that oversees the investment management process. And because you don't have just one or just a couple of concentrated underlying investments, you have a whole bunch of underlying investments. The other advantage is that this type of investment vehicle is automatically diversified by its nature. So you have instant diversification and professionals managing the transactions of buying and selling the bonds and managing the bonds in the portfolio. Okay, so this analysis today is going to help us understand the overall performance of ETFs, the risks of those ETFs, the suitability of these funds within the investment portfolio for specific investors. We are going to take a look at bond funds, which are pools of different investment classes, and we try to achieve diversification through the purchase of multiple types of bonds, right? If you invest in one specific bond, you have concentration risk. If you invest in a dozen different bonds or a couple dozen different bonds, you have diversification, right? So if one or two bonds tends to underperform, hopefully others will outperform those underperforming bonds. You'll still achieve a decent return. So before I go any further, let me show you the source for this data. So I looked in several places before I could find anything suitable. I don't have access to Bloomberg, so that was off the table immediately. I looked at this. This looks pretty decent. There was another one I found a while ago. Where was this thing? Let me see if I can find that over here. I could share that with you too. This this thing is kind of interesting. Where's the other bookmarks? Oh, if I have it, I don't even know. Oh, maybe this is it. Investment funds. I think this is another one I looked at. Yeah. Yes. Okay. So you can sign in here. This is by BlackRock. Let me see if I can get this working. Oh, you know, I might already be signed in. I'm not sure. Okay, it's asked me to sign in. Okay, so I'll go ahead and do it. So this is one I considered. I ended up not using this, but it does seem kind of decent. I was looking for a few things that this one doesn't seem to have, so I kind of leaned away from this just almost as quickly as I found it. Maybe this is why it's too slow. So you have iShares here, yield to date percent, 1 year, 3, 5, 10, since inception over performance on the as the headers there. Let's look at the first one. iShares is by Barclays, I believe. This is a core S&P ETF. Um, so you have some performance here, average annual, cumulative, calendar year. So those things look okay. What else do we have here? Your keyword or ticker or fund a name. Let's try. Oh, you know what? I think this is the one I was looking at. ETFs. And then all. No asset class. Fixed income. Yeah. So 133 corporates and they have everything. Okay. So nice. So let's take a look at this just quick here. I'll go down a little bit. So you have 6 times, I think it's 25 per listing here. So I'll just pick the very last one, just a random thing here. iShares ladder ETF tips is treasury in what's that, inflation protected securities. I think this is protected against inflation moves, right? So if inflation increases like it is right now in our current inflationary environment, this instrument will actually pay more money. So you don't get locked into some type of bond fund where you have to sit there for years and years, and the inflation is basically eroding the purchasing power of your investment. So it has some details: NAV, net asset value of the fund, growth of hypothetical. They start with 10,000, so this is 10 different bonds because each bond is worth 1,000. They have some details, key facts, so on and so forth. So, you know what? I will put that in my notes here. Wait, let me go back here. Let me go back to the main page. Where was that thing? Other bookmarks and down here. So I'll share this link with you guys, but I'm not actually going to use this resource. I almost did. It looks pretty interesting. Or whatever, just Google it. I don't want to spend all the time on this. Investment funds by BlackRock. So that looked kind of appealing, but I went in another direction. I went with this over here. So Morningstar funds. This thing I found just a few days ago, and this looks pretty cool. So we have Morningstar Best Investments Bond Fund. If I go over here, I'll share the link in the notes, and I'll give you all the notes when I post the video later today. So to find this, basically, I went to, I think, ETF. Oh, no, bond. I think I went over here to bond. And there's a couple different types of funds: core bond funds, core bond, core plus bond, corporate, and you have a few more down here. Hughes Munis. These are issued by government entities or local, state, or municipal, like City of New York, City of Los Angeles, things like that. So this is the one I ended up going with, core bond funds. Okay, and I put that link right over here, so you can go ahead and take a look at that at your leisure. Basically, we're looking at a couple different things for each bond fund. The capture ratio, this measures how much the bond performs relative to its benchmark. The upside capture ratio measures how well the ETF performs during periods when the market is rising. Okay, so capturing the upside. Downside capture is the opposite. How well does bond perform in market declines? And there's different types of bonds, right? Like government, corporate, munis, treasuries, treasury inflation protected securities. Okay, so that's what we just saw a few minutes ago. TIPS, they're abbreviated TIPS. Category tells you the classification of the bond. So you have short term, intermediate, long term. I think short term is like 1 to 3. Intermediate, I think, goes up to 10. Long term is 10 up to 30. High yield bonds could be bonds that pay a higher coupon payment, but these might be kind of garbage, lower ranked bonds or lower, what's it called, lower graded bonds. So AAA would be the best type. A low grade junk bond would be like a C or a D bond, maybe a CC bond, something like that. Each rating agency has its own methods for rating bonds and different sort of grading systems. I think there's a AAA. There's I forgot now. I used to get into all this stuff. That was a long time ago. But you can look at the different rating agencies: S&P, Standard & Poor's, Fitch, not Mitch. Sorry, Fitch and Moody's. Those are the big three. So you can look at the investment categories. They're pretty similar, but slightly different, right? So an index is basically a benchmark used to track the performance of a specific market or segment of the bond market. Okay, so there's a little more terminology over here. Before we get there, let me just show you exactly what we're talking about here. So if you go over here to this core bond fund, okay, let's take a look at this. So you have your quotes over here. NAV is net asset value, open price, bid ask spread. Bid is if you're going to buy it, ask is the asking price to sell it, and there's a spread in between. The market maker keeps that. Okay, so I tended to go into each of these bond funds and tend to focus on just these. We have alpha, beta, R squared, Sharpe ratio, and standard deviation. And then for each bond, you have the metric over here. This is the category metric. So let me show you what this is. The alpha measures the ETF relative to its benchmark. So a higher alpha indicates a better performing bond. A beta measures the sensitivity to the overall market. So 1.0 would be an average. Anything that has a beta of 1.5 or 2.0 would be 1/2 or 2 times as volatile as the market, right? So if the bond has a beta of 2 and the market goes up 1%, the bond will go up 2%. If the market goes down 2%, the bond will go down 4%. Okay, so R squared measures how much of the ETF's performance is explained by the movement in its benchmark. Sharpe ratio measures the risk-adjusted return of the bond. Okay, standard deviation is the volatility of the bond or the movement of the bond's price over time from high to low or low to high. Effective duration shows the sensitivity of interest rates impact on the bond price. Modified duration is similar, but it uses the estimated price change due to interest rate fluctuations. Effective maturity refers to the average time to maturity of the bond. And longer maturities generally carry higher interest rate risk, right? If the bond is a 30-year bond and interest rates are moving up and down, you have a bigger impact on the price than a shorter 1 or 2 year maturity bond, average credit rating. That's what we saw before. It could be AA plus, triple A plus, things like this, right? The higher the rating, the better the quality of the bond. Weighted coupon is the average coupon rate weighted by the market value of each bond. A weighted price is the same, but based on price, and yield to maturity is the total expected return of the exchange trade funds bonds held into maturity. Now, if the bond is called before maturity, then you're not going to get the full yield to maturity. And you can see this usually with mortgage-backed securities, right? They could be callable, especially if somebody pays off their mortgage prematurely, or corporate bonds sometimes could be callable too, right? Like the corporation issues the bond, Apple, for instance, or whatever the enterprise is that issues the bond, could call it back, and now it's not no longer available for you to invest in. Probably if interest rates are decreasing, it could be callable. Now the bond will be issued, or the enterprise will issue the bond at a lower interest rate because the market rate is coming down. So here's the code I put together. Let me kick this off. Control Enter to run it. And my light is going off again. Okay. Okay, so I took care of that. So let me minimize this window just a little bit and I'll show you what it's doing. You can see this thing running in the background as it chugs along. I'll continue with my narration here. So shrink the window just a little bit. So it's going to go through all these bond funds on the left that I just showed you. Okay, and one by one, it's going to open each link and go ahead and scrape out I think it's called the risk and the portfolio for each bond. Okay, so it is starting to move right now. Okay, so I'm sorry, so there's two parts of this. I kind of split it. It could be one or two, it doesn't really matter. So the first one is the UDF, that's the user-defined function, where I'll take you through this real quick. So we're looking at capture ratios, investment category index, and then portfolio headers, fixed income measures, investments, and category average. So I'm using Selenium right here. Selenium is a pretty dynamic web driver that allows you to do screen scraping on all kinds of web pages. So there's two ways to do screen scraping. You can use Beautiful Soup if it's just a static type of text and you're just trying to copy out the text into a Jupyter notebook or into maybe a list or a dictionary or something like that, and then push that into a data frame for further analysis. So Beautiful Soup is great for static types of tasks where the text is just statically displayed and all you have to do is copy it. If the text is displayed dynamically, like you have in this case, you would have to use Selenium to go ahead and do the screen scraping and then to click on different links. You can see we're on the risk link right now. Then we move to the price link. I'm sorry, the portfolio link. Yeah, so each ETF, we go into the ETF, we start a quote, that's sort of like the landing page, right? And then we go over to the risk tab. You can see the code is doing this right now. It's chugging along. I'm not even touching the keyboard or the mouse. So we click on risk. Then we go over to portfolio, scrape out the contents for each one. Okay, and we are building a data frame with the contents of all of these ETF bond funds. Okay, so that's what this thing is doing. So that is going to take a few minutes to run. Probably takes close to 10 minutes. So I will continue with the narration here. We don't have to sit and watch it. I just wanted to demo like what's going on here. And this was the only like feasible bond data that I could really find. So this is why I went over there. There's many sources. There's, I think, was it Trace data from FINRA, Bloomberg. I don't have access to that. Morningstar is good. I looked at, what was the other one? Blackstone. That wasn't super appealing to me. Maybe they focus on different types of things. I don't know, but I was looking at things like duration, modified duration, time to maturity, like typical fixed income metrics. That's what I wanted to get. So Morningstar had that, so that's why I'm leveraging this resource right here. So, and you can see I created a couple ETFs over here to go ahead and get the data. This is processing bonds. We're looking for headers, clicking on these links. Here's the risk link. Here's a portfolio link like I just described. So Selenium actually does the lift for us. It takes a little while. Probably took me over an hour to put this all together. It takes a while. But if this is something that you do on a regular basis, you really want the code to do this for you, you can click it and go ahead and walk away and go get your morning coffee or whatever, and you come back and it's done, or whatever, go do some chores and come back and it's done. You don't want to get into a position where you're doing this manually, especially if there's a lot of these things, or if it's a repetitive type of task that you do over and over. You really want to automate the task, right? The first 10 years of my career on Wall Street was focused mostly on automation, trying to do things quicker, easier, simpler, more streamlined than what you would do by clicking on it or typing on the keyboard, right? That gets pretty stale pretty quickly. So here's the next UDF scrape risk table. So that is going to go ahead and get all the bond names. We have a list called data.append is the task that is being done, and we're appending the bond name plus the risk headers into this list. So if I go here and go up and hit data, so here's the list right here, right? It's indicated by these square brackets. So that's scrape risk table, and then scrape portfolio table. So it's just two tables. We go into each ETF link, scrape out the risk data, scrape out the portfolio table data, and we are done. Okay, done, D-O-N-E, done. So I'm going to wait for that to finish up and just take you through a little bit more here. It's probably, I guess, 2/3 of the way through or 3/4 of the way through. So bond elements, we're looking at the row header here and printing any links. Okay, so that's what it's doing. Okay, so this is the last step. It's actually doing this now. So here's all the links that it found over here is 25 in this case. I think it's like 480 something bonds. I'm not going to get 480. All I need is 25 to illustrate the point of what's being done here. So it's going to navigate to portfolio page, portfolio table found, and it scrapes it. Bond name, navigate to risk page, risk table found, navigate to portfolio page, portfolio table found. Okay, so it's the same thing over and over. Very highly iterative process. We're going to go ahead and name the data frame columns down here when we get here. And we are actually going to take all the category names. If you look over here, we have category name and category average. Okay, and if this is false, let's see, where is it? Give me a second here. I did this code a couple days ago, and now I'm already forgetting. So it's good to have notes in the data. Capture the rows associated with each. Capture ratio. Okay, yes. Okay, I know what's doing. Okay, so I'm guessing it's mostly done now, probably 75, 80% done. And I'm going to take, now this data comes in kind of weird. It comes in this vertical or melted format. So we have to do some transformation on this. I'm sure you've heard the term ETL, extract, transform, load. So extraction is what we're doing right now. We have to do some transformation just to clean up the data. And then we will load it into basically, it's just a simple chart, a plotly chart. There's not like a whole lot of loading into a database or anything at this point. It's just loading into a chart so we can visualize what's being done here. So let's wait for the code to finish up. I think it's getting kind of close to the end, hopefully. Fingers crossed. Okay, but you can see the way that the data comes in. You have the fund name here, repeating over and over, capture ratios, metrics, category index. So it's kind of a wackadoodle kind of setup here, the way it's given to us, but that's fine. We can use some basic transformation in Python to get this structured and straightened out and looking very nice, cleaned up and refined in a fashion that it's much easier to work with compared to the current state that it's in right now. So give that a couple more seconds. Okay, and then when we get on here, we're going to look at basically these types of things over here. So these tend to be more equity types of metrics: alpha, beta, R squared, Sharpe ratio. I gave you the definitions. Everything is located up above my notes over here. So if I go over here, you can see these. There it is: alpha, beta, R squared, Sharpe ratio, standard deviation. So these are really more equity types of metrics that we're looking at. And that's fine. We'll just work with it at the beginning. You'll see how it works in a couple moments here when the screen scraping finishes. And then we're going to switch over to the actual traditional, more fundamental analysis for bonds, which is more like duration, modified duration, things like this. So that is really bond specific. And you'll see how if you do an equity analysis on these bonds, it really doesn't work that well, although it works kind of well. But really, the way that you want to handle this is with bond metrics. So you can apply equity analysis to bonds, but you're going to see it sort of works, but not really. I mean, the halfway decent attempt. But the best way to analyze a bond is really to use bond metrics, and we'll prove that in a couple of minutes here when the screen scraping tool is all done over here. American Century, I can't even tell where we are. All right, sorry, let me get rid of this guy. I get like 100 phone calls a day from recruiters all over the place. Oh, okay, so, okay, done. Nice. So we can continue on. So we have all our bond data. We are going to do the next step here and refine it a bit, clean it up, and just look quickly at the head and the tail. I don't want to drag this on and on. We've already taken a little while to do the screen scraping. So, and by the way, I'm going to give you all this code like I do with every one of my videos. I'm going to turn over all the code to you so you can do this for yourself, and you can take some time to dig in and see what the code is actually doing and really learn from this exercise. That's the point of all these videos, right? For me to learn myself, I love learning new things. I put this together every time I do it. I learn a couple new tricks here and there. I'm adding tools to my toolbox every single day. But it's really for you guys to learn, right? If you know this stuff, that's fantastic. You can slice through it really quick, or maybe just bypass this video altogether. People that are clicking on this video and most of my videos don't necessarily know this stuff, so that's why you tune in to learn something, right? So this, I think this was done 204. Let me see, 203, 204. You can tell by the increment here. So 204 is right there. That was done. This was previously done. That's so you can tell where we are. This is 186. So that is not sequential with the other two. So I know that's the next step. Okay. So let's look at this. This has been cleaned up quite a bit. We have capture ratios, metrics, category, index, and we have all of our data converted into numerics. Before this, we had some non-numerical data and a couple of nans. A nan is not a number, N-A-N. So anything that is not numeric has to be coerced into becoming numeric. PD to numeric is pandas data frame to numeric. And if anything is an NA, it gets filled in with a 0, just to clean it up, because the plots and charts that we use later simply won't work if there's nans. It doesn't know how to interpret that. Okay, so we're going to split the numeric into risk and portfolio like we saw in those links before. So here's the split. We have the, let's see, portfolio display risk, DF head, data frame head, and portfolio data frame head. So here's the risk head. Here's alpha, beta, R squared, Sharpe ratio, standard deviation. These are the equity metrics, and these are fixed income metrics: effective duration, modified, effective duration, and modified, and then effective maturity. Okay. And that's fine. I don't know why this one showed up twice, but we'll handle that. We'll delete any duplicates. So now if we look just the risk data frame, and we're going to go ahead and take the mean of all of these and group by the fund name and the capture ratio, because we can't have duplicates over here. That's a dupe, 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 right? So we have 5, 0 through 4 is 5, alpha, beta, R squared, Sharpe ratio, and standard deviation. But we want to clean this up. This is a very wackadoodle, kind of a totally wacky way to look at the data. We want to take this and pivot it so it's just easier to visualize and to work with and more intuitive. So now we have 1, 1, 1, 1, 1, 1, 1, so on and so forth. And we have the headers at the top: alpha, beta, R squared, Sharpe ratio, and standard deviation. So we're in good shape. Now we took everything, those 25 bond funds from Morningstar, and transformed that into a shape now that is easy to work with and pretty intuitive as well. Okay, so this next thing, okay, yes, so now we're going to go ahead and assign some rankings. So for most of these, higher is better. Higher alpha is better, higher R squared better, higher Sharpe ratio is better, higher standard deviation could be better. I mean, it's going to be a little more risk, but we're going to say higher is better. Lower beta is better, right? So less sensitive to market volatilities is going to be better. So everything that is not beta, I'm going to rank in descending order. So top to bottom, the higher is better. Here it's going to be ascending, so lower numbers are better. Okay, so let me go ahead and run this, and here is the final outcome. The ranking does everything. Now we have this bond fund with alpha, beta, R squared, Sharpe ratio, standard deviation, a total score 3.90. Okay, so in this case, This is the rank, the total ranking score. I could call it something else. I call it the total score. 3.9 is the best bond fund. Okay, lower is better, higher is not quite as good. And I can prove this to you right now. Alpha is 5.0, that's good. Beta 17.5, that's good. R squared 6.0 is good. Sharpe ratio 5.0 and standard deviation 5.5. That is going to give us a total score of 3.9. Okay, and if you look at over here, I have some notes. If you want to do weighted, if you want to weight the metrics differently, you can certainly do that. I gave an alternative guidance on how to do that down here, but basically I'm taking everything in ascending order fault, so it's going to be descending, so higher to lower, except for beta, this is going to be ascending. So ascending equals true is ascending, ascending equals false means descending, and we're going to go ahead and, where is it right here? Filtered by, oh, dot rank. So this right here does all the magic. Dot rank is the property that does all the magic for us. This creates a nice looking data frame. Okay, and here is the a couple more definitions. Higher values are better, ascending equals false, beta lower values are better, R squared higher values are better, higher rankings, Sharpe ratio higher is better, and the total score is the sum of all the ranks for a fund across all metrics. So alpha plus beta plus R squared plus Sharpe. Okay, so the higher the score, the worse, the lower the score, the better. Let me go ahead and plot the results using a Plotly map. I love these Plotly maps because they're dynamic, interactive. You can zoom in, you can zoom out, you can put the mouse over it, and it shows you all the details of what is being plotted. So it's very, very nice compared to the old Plotly, compared to the old MATLAB plot or the Seaborn plots, which will do essentially the same thing, but they're not interactive like this. So when I put the mouse over, you can see the pop-up item over here. Again, here's a total score. This one's a little bit hard to see. We can see it's 39 when I put the mouse over. Without that, it's kind of hard to read. You can go down here, you can see this is actually the worst score, and that is has a total score of 78. So I put this into Microsoft Excel, and let me show you how this works here. So let me try to scrunch this over a little bit to the side. I think this is fine. Okay. So if you go up here, let me see. So we said the best is MBDLX. Okay, so the best is MBDLX, and the next best is WTRIX right here. So what's in blue, and MBFIX. Those are the top three, okay? And the bottom three is IDPAX, CDBCX, okay? So that in orange, that one in orange, and IDPAX. So this is the bottom three. If you look right here where my mouse is, these are the bottom three, and these are the top three. But look at the performance. If I look at the top three performances and sum these together, I get an average of negative 2.36%. And this one, plus this, these are the worst, 2.34%. So they're pretty close. All these bond funds are actually down during the period that we're looking at. I think this goes back, what was the period? 1 year or something? Jeez, I actually forgot what the period is. This is taking everything straight from Morningstar. So whatever that period is in Morningstar, let me see if they show it. It might be year to date, or it might be 1 year back as of the current date. Oh, let's see. I can't even tell what this is. It might be, which is 2025, 24. Wait. Okay, this is the first time I'm seeing this. I haven't looked at this before. But it doesn't even let me change that. That's weird, man. Start date. Oh, you have to click on the thing. Okay, that's right. Okay, so it's down. So, I think I'm gonna hazard a guess here. I think this is going back 1 year in time, and that's fine. It is what it is. Almost all these bond funds are down. Only AFIX is up in the past year, and this is only 25 bonds. It's the first 25 on the page. So, it's not all the bond funds are down. It's not everything. It's not like the bond market's crashing. Actually, bonds were pretty big. They were up pretty big in 2024. So we just picked. I happen to pick 5. Where did we leave off here? Give me a second. We happen to pick 5 that just didn't perform, 25 that just didn't perform that well, and that's okay. And again, I wanted to show you 2 sides of this. We're looking at the equities now. We're looking at the R squared, the alpha, the beta, standard deviation, and it is one way to analyze these bonds, but it's not the best way. So let's look at a true set of bond metrics like effective duration, effective maturity, things like that. That's really designed for bonds. So we're trying to squeeze a round peg into a square hole or a square peg into a round hole, and it's just not fitting. It's just not really working, not really doing what we want to do. So let's try a different approach. I'm going to go ahead and pull in historical prices for all of these bonds, and I'm going to take the most recent price. Okay, we're pulling in all this from Yahoo Finance. I tried to get this from Morningstar, but it was really clunky and just didn't really work very well. It was very inconsistent, and after a while I gave up and just went to Yahoo Finance. So here's all the bond prices and the returns. You can see, whoops, my light went out again. Okay, you can see all of these bonds over a period of, let me double check this, just so I don't misrepresent here. Oh, 1 month. Okay, it's just 1 month. We can make that 12. We can make that 12 and redo this. Let's go back 1 year. Okay, so the relative time back is 12 months from the current date time. Okay, so we have that. Let us go ahead and rerun the analysis here. And we have some ups and downs. This one is up a lot, 84%. No, that's surprising. IDPAX, let me look at this thing. IDPAX. IDPAX, where are you? IDPAX. Okay, so let's go back 1 year. Intermediate duration. Okay. 2.2%. That's weird. 2%, right? Year to date, nothing. Wow. 5 days it's down. Oh, 5 years it's down 18%. Oh, yeah, you might want to stay away from that one, guys. Okay. So let's go back here to the analysis. So anyways, let me go back 1 month. That might be what Morningstar was doing. Maybe that's why I picked that to begin with. Let's go back to that and redo this thing. Okay, that's fine. This is pretty dynamic. We only have to change a couple of variables. The only things that would change in here is these ticker inputs, and then the relative time back. You can go back 1 month, 3, 6, whatever your heart desires. That's up to you. That's what you pick. It does make a big difference in your investment portfolio, right? If you go back 6 months, that could be a fantastic time to do investing. That could be a horrible time to do investing, right? 12 months, 18 months. It really depends on what the market is doing. And we don't know that until we're invested and looking forward, right? You can look back in time and understand quickly and easily what's happened, but to look forward, it's literally impossible, right? It's like your life. Like life can only be understood backwards, but can only be lived forwards, right? You can't live your life backwards, and you can't understand your life forward. The market's kind of the same. You can look backwards in the market and understand it. You can look forward, but you're not going to understand anything. Your life is kind of like the stock market, right? So we have all the fun names: alpha, beta, Sharpe ratio, standard deviation, total score, and then return. Now, I'm not actually using the return. I just wanted to line everything up just so you have a quick, comprehensive understanding of what everything looks like when it's all lined up. You can see these ticker symbols line up too. So that's pretty cool, right? So let us look at fund name, capture ratio, and metrics now for the portfolio data frame. So now the portfolio is different from the risk. The risk is more equity type of analytics. The portfolio is effective duration, effective maturity, modified duration, weighted coupon, weighted price, and yield to maturity. Okay, so that's how much return you're going to get from that investment if you hold it into maturity, if you don't sell it, or if it doesn't get called away from you. So let us go ahead and do the same ranking that we saw before. So usually ascending equals true, like in the beta. So effective duration, lower is better, modified duration, lower better. That's what this is telling us. Otherwise, ascending equals false. And this is doing all the magic. This property.rank is doing all the magic for us. So let me hit Control Enter to refresh it. And plotted, what is it saying? Index contains duplicate entries, cannot reshape. Oh, I know what happened. Oh man, so there was, I think, let me see, 218, 217, 218. Taking the first. Let me try one more thing here. If this doesn't work, we'll just skip ahead. So you can't have duplicates in this pivot data frame, but I thought those were eliminated. Let me try it again. If it doesn't work, that's okay. We'll just move forward. Yeah, it doesn't work. You know, I'll clean this up. Let's go forward with this. If I refresh this, it's going to cause an error. I'll clean this up after I wrap up the video. It's already been, wow, it's been 35 minutes. Time flies. So I'm not going to refresh this because it's going to destroy the plot, but I'll fix that code and then save it, and I'll send this, when I send the video, I'll send this up to YouTube, and you guys can grab it with the refactored code. I have to just take a look. It must be one security that had dupes I didn't drop. So again, the lower numbers are topped at the total score. Now instead of equity metrics, we're looking at fixed income metrics. So we have the effective duration, effective maturity, modified duration, weighted coupon, weighted price, yield to maturity, and total score. Lower is better. So let's look at what we have now. AFIX, if I go back to the spreadsheet, go over a little bit. So AFIX, next one, ADFIX, and then ACBPX, that's number 3, okay? ACBPX, that's the third one. Now, if we go to the bottom 3, GHQIX, that is right here. GHQIX, that's pink right in the middle. GHQPX, that's number 14, and GHQYX, that's number 17. So if I take the average of these, it is negative 3.34. If I take the average of these, not quite as bad, negative 1.27. So you can see when you analyze bonds using true bond metrics and aside the rankings, the top 3 investments are picked for you. AFIX, ADFIX, and ACBPX are really the best performing bonds in this whole universe right here. It's only 25, right? It's not everything. I think originally we had like 480, but I'm not going to screen scrape 480. It's going to take way too long. And the point of this is to show you how to analyze fixed income instruments. It's not a screen scraping exercise. So we get coming up on the tail end of the thing. Okay, give me a couple more minutes. Thanks for hanging until the end of this. It's a long one, but I think it's a good one too. So the yield to maturity shows you how much you would gain from an investment perspective. Like, no, the percentage return. The YTM is a percentage return if you held it to maturity. When the bond's price falls, the coupon payments become relatively more attractive because if interest rates are going up, it's going to cause bond prices to fall because higher interest rates mean new bonds are being issued with a higher coupon payment. So existing bonds that have lower coupon payments are going to fall in price. If interest rates go down, new bonds will be issued at a lower interest rate, so lower coupon to the investor, which makes outstanding bonds more attractive, and the price will increase over time. Okay, so there's 2 ways to make money in bonds: by coupon payments and by appreciation. And you can lose money by depreciation, right? But the coupon payments won't change unless the bond gets called away. That's the only way. When the bond price rises, the payments represent a lower return on a higher purchase price. Okay, rising YTM is good for the investor. That's a percentage return on your investment. Portfolio value for existing investors sees a decline in the value of their holdings as the prices fall. But again, interest rates are rising, right? If bond prices are falling, interest rates are rising. It's always an inverse relationship. The market conditions can decrease bond prices. It can also increase bond prices. It's kind of random. It really depends on what the Federal Reserve is doing and how they decide to change interest rates. Weighted price, weighted coupon, modified duration measures the sensitivity of the bond's price to changes in interest rates, right? That's what we just said. Higher interest rate, lower bond price. Lower interest rate, higher bond price. It estimates a percentage change in the bond's price for 1% change in interest rates. Okay, and then effective maturity shows the average time to receive cash flows adjusted for the probability of prepayments. Okay, so prepayments can occur basically only on mortgage-backed securities, right? If a homeowner or a whole bunch of homeowners prepay their mortgages, the instruments will be prepaid, and if you have a you can actually carve those up a couple of ways. You can have an interest only or a principal only, so it will affect the interest only. And I think the principal only is impacted to a lesser extent. The last time I studied that was years ago. I think that's how it works though. But effective maturity is pretty balanced and pretty stable unless you have a mortgage-backed security or some type of callable bond. That could be callable issued by an institution like a corporation, right, or a MBS, a mortgage-backed security issued by some type of investment bank, right, but carved up, or they'll buy a whole bunch of homeowner loans and then carve those up into different tranches, right. An effective duration measures bond sensitivity to changes in interest rates. So just to wrap it up here, fixed income analysis is useful for a bunch of different things: assessing yield, risks, diversification and asset allocation, performance evaluation, liquidity fund management, inflation protection, capital preservation, and risk mitigation. And there are tax considerations for everything you do, guys. So everything you do, every time you turn around, every time you breathe in and breathe out, you're paying taxes, and some kind of tax consequence for everything. So keep that in mind too. You don't want to trade equities and fixed income instruments all day long unless it's in a tax protected account like an IRA or a Roth or something like that, right? That's the only way you'll evade taxes. And if you don't have it in a tax sheltered vehicle like those retirement accounts, your tax reporting on April 15th is going to be a nightmare. I've been through that. It's not a ton of fun, but that's it. So fixed income analysis using Python. I will correct this mistake over here. I know what it is. I'm going to have to really Google it and take a quick Google look because I don't memorize any of this stuff. I figure it out as I go. I just don't like to memorize things because I think it's a waste of brain power, but I'll figure this out. I'll get this fixed and I'll post all the code in my posted video later today. Thanks for your time, everybody. Hopefully this was a good learning experience for you. I know it was for me. Goodbye.